Welcome back to our channel, where we delve into the fascinating world of finance and business metrics. In today's video, we're diving into the topic of EBITDA, earnings before interest, taxes, depreciation, and amortization. So, if you've ever wondered what this acronym means and why it's important, you're in the right place. EBITDA is a financial metric commonly used to assess the financial performance of a company. Let's break it down. The letter E stands for earnings, which is the net income or profit of the company. It is calculated by subtracting the total expenses from the total revenue of the company. B stands for before, which means that the following components are not deducted from the earnings. I stands for interest, which is the cost of borrowing money or the income from lending money. Interest expenses are deducted from the earnings to get the net income, but not from the EBITDA. Stands for taxes, which are the payments that the company makes to the government based on its income or profits. Taxes are also deducted from the earnings to get the net income, but not from the EBITDA. Stands for depreciation, which is the reduction in the value of the company's fixed assets, such as buildings, machinery, or equipment over time. Depreciation is an accounting expense that does not involve cash outflow, but it reduces the earnings and the net income of the company. Stands for amortization, which is similar to depreciation, but it applies to the intangible assets of the company, such as patents, trademarks, or goodwill. Amortization is also an accounting expense that does not involve cash outflow, but it reduces the earnings and the net income of the company. Earnings refer to the money a company makes after deducting its expenses. When a company sells its products or services, it earns income. However, it also has to pay for various things like raw materials, employee salaries, utilities, and rent. After subtracting these expenses from its income, what remains is called earnings. Earnings can be seen as a measure of how profitable a company is. It indicates how much money the company is actually making from its operations. Higher earnings generally indicate a healthier and more successful company, while lower earnings might suggest challenges or inefficiencies. Earnings are an important consideration for investors, as they help assess the financial performance of a company and its potential for growth. Interest. Let's take a look at the different types of interests. Simple interest is usually paid at the end of the loan. This is the amount of interest due on a loan, based on the principal amount, the interest rate, and the time period. For example, if a company borrows $10,000 at 5% annual interest rate for 1 year, the simple interest is $500. Here is the calculation. Simple interest is usually paid at the end of the loan term or periodically. The next type of interest is accrued interest. This is the amount of interest that has accumulated but not yet paid on a loan or a bond. For example, if a company issues a bond that pays 6% semi-annual interest and the interest payment date is June 30, the accrued interest on March 31 is 3% of the bond's face value. Accrued interest is recorded as an expense for the borrower and as income for the lender, and it is settled when the interest is paid. Next is compound interest. Compound interest is the amount of interest that is calculated on both the principal and the accumulated interest of a loan or a deposit. For example, if a company deposits $10,000 at a 5% annual interest rate for 2 years, and the interest is compounded annually, the compound interest is $1025. Compound interest is usually paid at the end of the loan term or periodically, and it can grow faster than simple interest. The next type of interest is operating interest. Operating interest is the interest that is related to the core business activities of a company, such as interest earned from customer deposits or interest paid on trade payables. Operating interest is usually included in the operating income or EBIT earnings before interest and taxes of a company, and it reflects the normal operations of the company. And the next type of interest is the non-operating interest. Non-operating interest is the interest that is related to the financing or investing activities of a company, such as interest earned from bonds or interest paid on loans. Non-operating interest is usually excluded from the operating income or EBIT of a company, and it depends on the financing structure of the company. Different companies have different levels of debt and equity, resulting in different interest expenses or income.
Now let's jump into the next component, taxes. Taxes refer to the amount of money that a company pays to the government based on its taxable income. The tax expense is calculated by applying the applicable tax rate to the company's taxable income, similar to interest excluding taxes from EBITDA. The fourth component of EBITDA is depreciation. Depreciation is a non-cash expense that reflects the decline in value of a company's tangible assets, such as buildings, machinery, vehicles, over time. It is calculated using depreciation methods and estimates determined by accounting principles. And the last component of EBITDA is amortization. Amortization is similar to depreciation but applies to intangible assets such as patents, trademarks, copyrights, instead of tangible assets. It represents the gradual reduction in the value of intangible assets over their useful life. Excluding amortization from EBITDA separates the impact of these non-cash expenses from the company's operational performance. In summary, EBITDA, earnings before interest, taxes, depreciation, and amortization, is a measure of a company's operating performance by excluding financing costs, interest, tax expenses, and non-cash expenses. Depreciation and it provides a useful metric for evaluating and comparing the profitability and operational efficiency of different companies within an industry.